Imagine you pay $10 to rent a bike for an hour. If you return the bike late by 15 minutes or more, you will be charged for another hour. And you ended up paying $20. This is just like taking up a loan. The bike represents the loan. The rental charge represents the interest, and the late fee represents the penalty and extra interests a borrower needs to pay when late in repayment. People usually borrow from the bank. A typical loan gives the borrower a lump sum of money, and then the borrower repays the lender little by little over a period of time. In return for this, the borrower pays some extra money to the lender, and that extra money is called interest to the loan. Interest is the cost of borrowing and is also income to the lender. Some common types of loans you can find in Singapore are business, mortgage, education, car, and personal loans. Not forgetting credit card, which is a kind of revolving credit. Taking loans allow the borrower to own something that is important and needed when they are short of cash, and also helps free up their cash for other purposes, as they can break up a one-time large payment into many small repayments over a period of time that they feel comfortable with. They can also put the cash into investments that could potentially generate extra income. As mentioned, taking up loans are sometimes necessary when you need to make certain big purchases that are important. For example, in Singapore, a big proportion of HDB flat owners and private property owners have outstanding mortgage loans. In 2025, more than 9 in 10 resident households own the residence they stay in according to published sources. What does these numbers tell you? These numbers tell you how culturally important it is for Singaporeans to own properties. Owning a house is owning a safety net. The availability of mortgage loans plus government policies play a part in helping people realize their dreams of owning a house and building their families in it. But what are the risks of borrowing? A loan is a debt. The more loan a person borrows now, the more interest and the more debt the person has to repay in future. Debt will grow when the borrower takes up more loans, takes up bigger loan amount, borrows with higher interests, or is late in repayment. Overborrowing happens when someone borrows so much such that they have a problem repaying the debt later. When that happens, their outstanding debts continues to attract interests, which adds to the debt, and the debt could grow further, which eventually lead to financial difficulties. The ways to avoid this are: 1. Borrow only what you can repay, and for what you need only. Be clear how much you will owe, including the loan amount, interests, and all fees involved, and assess if you can repay the loan comfortably later. There are professional tools to help you with this. Do not borrow for wants. For example, if buying a bigger house for a small family stretches your ability to repay, then go for a smaller house. If you just need a functional car for convenience, there is no need to buy a luxurious car. 2. Compare the lenders. Different lenders offer different interest rates and conditions of repayment. Borrow at the lowest cost you can find and on terms that best suit you. 3. Set aside enough savings to service the loan when you become cash-strapped. For example, during retrenchment. Ensure you have a buffer from your savings to repay the loan in case you do not receive the future money as expected. As a rule of thumb, have cash on hand to cover at least 3 to 6 months of essential expenses and other obligations. The more the better, of course. 4. Pay on time, every time. When you have the discipline to repay your loan on time, you avoid any potential extra charges. Taking loans have benefits, but always remember, be a smart borrower and borrow responsibly. Do not overborrow. Stay smart, stay cool, and stay future-proof. If you learned something from this video, please subscribe. Thank you.